Smith and the Southwest Florida Daily Tour of Homes and Foreclosures, and I'm your host here for the day. We cover the areas of Sanibel, Captiva, Naples, Bonita, Fort Myers Beach, Cape Coral, Port Charlotte, and Punta Gorda. So if any of those areas down here in Southwest Florida, you're looking either to buy a home or to sell a home, we'd be honored to be your exclusive buyer's broker or your listing agent. We've sold 100% of our listings, and about 90% of our buyers that end up working with us end up closing on a wonderful home for them or their family down here. Today I'd like to take a few minutes and talk about FICO or credit scores, how they work, how you can improve them, how they're affected by different things that you do. When you buy a piece of property, your credit score is probably the single most important thing that goes on. So I'm hoping to give you a little bit of information on your credit scores and that sort of thing. So let's just call this a topic of how to increase your credit score. Credit scores are one of the largest factors that lenders use in evaluating whether or not to lend money to a borrower. Credit scores are designed to measure the risk of someone defaulting by taking into account various factors in a person's financial history. As you know, Carol and I are both mortgage brokers in both the state of Washington and Florida, as well as real estate brokers. So we see this kind of thing all of the time in dealing with a variety of clients in all different price ranges. If you're considering purchasing a Florida home, or a home anywhere for that matter, one of the things you want to be sure of is the accuracy of your credit report. The economic downturn of the last 5 years has vastly changed the mortgage landscape all across the country. If you ask any mortgage broker, they'll tell you that things have changed in the mortgage industry on a monthly basis. Given the increase in foreclosures and short sales, lenders have increased their standards when evaluating the potential for default of every borrower. Now, I have listed on the Facebook page the time to wait before you can get another mortgage for everything from foreclosures to short sales, bankruptcies, and all that sort of thing. Go in there under the photos, and it'll be there. I took a photograph of the piece of paper, and it'll be in there as well. One of the tools that lenders use to evaluate the borrower to repay a loan is what's known as their FICO score. The FICO score was developed by the Fair Isaac Corporation. The company was founded in 1956, and their scoring programs are often used to assist lenders in managing credit accounts, detecting credit fraud, and automated lending decisions. The FICO score is a standardized approach that helps lenders deliver decisions on loans in a very efficient manner. FICO scores range from 300 to 850, with 850 being the maximum possible score. I've never had an 850 client, but I have had an 830 client. According to the FICO scoring system, there are 5 factors that determine borrower score. Using these guidelines can help you improve your credit score, and I'm going to get into exactly how you can do that here in a minute. I want to tell you that 35% of borrowers' payment history carries the most weight. Late payments on bills, including mortgage, credit cards, or automobile loans, can cause a consumer's FICO score to go down. Paying your bills according to your contract you sign will, over time, help improve a customer's FICO score. We all know that. 30% of the borrower's credit utilization, which is the ratio of the current outstanding debt, such as credit card balances, to the total available revolving credit, which is your credit limit. You can really improve your FICO score by paying off debts and lowering your utilization ratio. The closing of existing revolving accounts will typically adversely affect this ratio and therefore have a negative impact on your FICO score. So in other words, if you have one credit card that you have a $5,000 limit and you have a $4,000 balance, that's going to hurt your credit score. You're better off to have 2 credit cards of $5,000 and split that $4,000 up between the 2 of them. In other words, you don't want to have high limits on your cards. You're better off to have more cards. And if you have cards you're not using, closing them reduces that ratio, which is also going to hurt you. Most people think if I get rid of those things, it makes me look better, and on the fact it does hurt you. 15% is the length of credit history. Your credit history gets longer, assuming you pay your bills on time. It can have a positive impact on your FICO score. And 10% of types of credit used, like installment or revolving or consumer finance. There is some credit given to having a history of managing different types of credit. And 10% is a recent search for credit on the amount of credit obtained recently. If you have multiple credit inquiries as a consumer seeking to open new credit, such as credit cards, retail store accounts, or personal loans, it can hurt your score. Applying for lots of new credit in a short period of time is also viewed as risky and can cause a drop in an individual's score. What should you be done to do this, however, is that if you're shopping for a mortgage or auto loan over a short period of time, you should not experience a decrease in your score as a result of these types of inquiries. So in other words, if you're going to several mortgage lenders who are pulling your credit, although I always advise pulling your credit yourself and taking that credit report to your lenders, asking them not to pull it until you decide to actually get a loan from them, and use your own credit reports. You can pull all three of them yourself. You get one free credit report that you get to pull yourself every year. And don't go to the credit reporting agencies to pull those. Go directly to the credit reporting agencies. You can go to TRW, you can go to TransUnion, you can go to Equifax directly. Don't use the companies that'll sell you a package for $49.95 or that sort of thing. Go directly to them and get 3 independent credit scores and credit reports from each one of those. Your FICO scores do not take into account the borrower's salary, employment history, where you work, rental agreements, child support, or any other obligations or interest on any current loans. Generally speaking, a credit score that is over 720 is often considered an excellent credit score. A score of 680 to 719 is considered good. A score that falls in the range of 620 to 679 will usually make the lender scrutinize the file further. Having a score that falls between, say, 585 and 619 will typically disqualify you from getting the best rates. A score below 584 will make many lenders question whether or not they want to do business with you entirely. There are actually 3 companies that report credit scores to lenders. There are Equifax, Experian, and TransUnion. The scoring of these agencies can often vary quite a bit. Each of the bureaus collects different information on the borrowers, which can change the final score. Given how the credit score can differ from the various agencies, if you're falling on the edge of one of the credit ranges, it may be prudent to apply to more than one lender. For example, if you had a score of 675 at one agency, it's quite possible you could be 700 somewhere else, which could give you a better rate. It should also note that the credit scoring model was slightly altered in 2009 and could affect your score either up or down by as much as 20 points. In the new model, credit problems and issues will be ranked accordingly to the number and magnitude more specifically than before. The new FICO scoring system also focuses less on how many accounts a borrower has and more on the amount of balances carried. Hear that? Balances again. The statistical models that are used for generating credit scores are subject to federal regulation. The Federal Reserve Board's Regulation B, which implements the Equal Credit Opportunity Act, expressly prohibits a credit scoring model considering prohibited bases such as race, national origin, sex, religion, and marital status. We all know that. However, the law also states that credit scoring models must be empirical and statistically sound. In addition, if a borrower is denied a loan based on credit, the lender must state the specific reasons for the denial. A statement that that person did not score high enough is not acceptable. The three reasons for denial must be specific. For example, there are way too many late payments for 60 days or longer. Something like that. So how does one go about improving their credit score to get the best rates that lenders offer? The answers are actually pretty simple. 1, pay your bills on time every month. That goes without saying. Pay off all your existing debt, or at least get it down to about 40% of your total credit limit. Unused credit cards should not be closed. This can sometimes lower your credit score. And do not open a bunch of new credit card accounts in a short period of time. Let me tell you a couple stories. I've had several times where clients have qualified for a loan to buy a home, and then they go out and while they're here in town, they buy furniture. I've even had them buy a car and buy all kinds of things thinking that, well, they qualified for their home loan, they're free and clear. However, the day before closing on your loan, your lender's going to re-pull your credit score. And so all that furniture or those credit cards that you bought, towels and linens and all of that kind of stuff for your new home is going to show up. And I have had people then not be able to get a loan on the day before closing on their homes. Don't let that happen to you. I tell every client, do not spend a dime on anything from the time that you apply for your loan to the time you close your home, because your home's the most important thing. You know, a few years ago, it was not uncommon to hear of mortgage brokers or credit repair companies doing what was known as doctoring a person's credit. A major portion of the FICO credit score is set by the ratio of credit used to credit limit. What was happening was that they would increase the score by simply increasing your credit limit. Some of the credit repair agencies, for a fee, would report to the credit bureaus that they have opened an account with a high credit limit. The customer could not actually use the account, but it would improve the customer's FICO score due to lowering the balance to the credit limit. This is no longer allowed. Also, when you're starting your home search, getting yourself a pre-approved letter from a lender is one of the things that you should do is get a copy of your credit report from each of the 3 credit bureaus like I stated earlier. As a consumer, you're allowed to get 1 free credit report each year from Equifax, Experian, and TransUnion. With this knowledge in hand, you should be well armed to position yourself for some of the best mortgage rates possible. There's a couple things you got to remember here in closing. One is go directly to those 3 companies. Pay, yeah, you may cost you an extra $20 or $25 to get the 3 reports directly from the lenders, but you're going to get much more accurate information. And on top of that, those are the companies that you're going to dispute anything with to get your credit cleaned up. Now, there's a lot of good books and manuals on how to clean up your own credit without going to a credit repair place. That's, for the most part, a lot of those are just scams and whatsoever, and they're just there to take your money. However, I've worked with a lot of clients and cleaned up a lot of credit reports, and one of the things that you can do is obviously you can dispute any facts that may be incorrect on your credit reports, and that's a great way to do it. Basically, how that works is that you go online after you pull the credit report, and you can dispute anything on your credit report that you believe is incorrect, and the lender has 24 hours, or excuse me, has 30 days to either come back and say, nope, it's really you and that is true, or no, in which case it's removed. However, the federal law requires the credit companies to remove anything on your credit, good or bad, if they don't respond in 30 days. So let's just say if you did it around Christmas time and things like that, or multiple times, is some of the things that some people have done, is a way that some of these credit repair companies have been able to get credits cleaned up from folks. But anyway, I'd be more than happy to talk to you more about how to repair your credit, how to get your credit stronger, and how to get mortgage, how to get pre-approved. You don't want to come down to Southwest Florida to buy a home without having your pre-approval letter already in place, plus a letter from your lender or your bank account balance information with the account numbers blackened out. When you call here, we require all of our clients to bring those to us before we ever show them homes, because realistically it's just a waste of your time to be out showing you homes if we know that that we may not be able to get you a loan. So you want to get all that stuff done ahead of time before you come in town. That way you can get the best deal. We can negotiate the best price, save you thousands on not only your mortgage and your interest rates and on your loan costs, but also be able to negotiate as you have cash, whether or not you're getting that loan or not. The federal government and HUD says that a loan is the same as cash. So if we know you've got a pre-approved loan, we can negotiate a purchase offer for all cash on your behalf. So give us a call at 239-872-7736. Let's go over how we can best help you get the best rates and the best loans and find you the best home for you down here in Paradise. This is Alan Smith wishing you a warm, wonderful Southwest Florida day. Give us a call, 239-872-7736. Bye-bye now.